Hey everyone, welcome back to T Accounts. So in this series of doing O-level accounting, November 2020, paper 23, we now have to solve question number 4, which is related to company accounts. So let's begin. The question says the directors of DW Limited provided the following information at 30th September 2020. So if this is the year end, my year start would be 1st October 2019, right? And then we have a list of balances. We have 6% debentures, overdraft, bank overdraft, dividends paid during the year, right? General reserves at 1st October 2019. So this means that the opening balance is given to us. Then we are also told the inventory at 30th September means the closing inventory. Then issued share capital at again 1st October 2019, so opening balance. Then non-current assets at 30th September 2020. This means that the closing figures are given to us related to non-current assets, its cost as well as its provision for depreciation. Then we have other payables, other receivables, provision for doubtful debts at 1st October 2019. So again opening, we might have to apply a percentage to find out the closing balance. Then we also told the retained earnings, trade payables and trade receivables, right? In additional information, it says a draft income statement for the year ended 30th September 2020 was prepared, showing a profit of 84,900. So this is the draft profit, 84,900. However, the following errors were later discovered. So we might have to correct these errors in order to find out the corrected profit, and that is the requirement in part B. Calculate the revised profit for the year after adjusting for errors 1 till 3, right? So let's read the adjustments one by one. The first one is related to inventory. It says inventory of 26,300 included items valued at a cost of 5,200 that needed repairs, okay? And after repairs costing, the repairs amount is 8,600. The items could be sold for 5,000. Which IAS is being applied in this adjustment? Can we guess? IAS 2, inventories, which says that inventory should be valued at lower of cost or NRV, right? Whichever of the two is lower. What is NRV? Net realizable value, the estimated selling price minus the repair cost to sell the inventory. So what can be realized or what can be earned from the sale of inventory after undertaking repairs expenses. So, and why is this? Why do we do this? So that our inventory and our profits are not overstated, which will be in compliance with the prudence concept. So we'll be adjusting the inventory in part A. Now the next requirement is, the next error is related to expenses. It says operating expenses included insurance of 400 that was prepaid at 30th September 2020. Okay, so prepaid expense is it part of the current year? No, it is paid in the current year, but it is not incurred in the current year. So since it isn't incurred in the current year, it doesn't belong to current year, it shouldn't become part of my current year's income statement, my current year's expenses. That is why it should be subtracted from the insurance expense, so that insurance isn't overstated and my profit isn't understated. And that we'll be doing in part B, in which we have to find out the revised profit after adjusting for errors 1 till 3, right? And third is related to provision for doubtful debts, which should have been adjusted so that it equals 5% of trade receivables. So we have already seen that we were given the opening balance, we just have to find out the closing balance, and the difference will go in the income statement, either as an expense or as an income. Further, we are also told that the directors decided to transfer 5,000 to general reserves, okay, and there was no change to the issued share capital during the year ended 30th September 2020. So this means that there were no shares in issue during the year. What was the balance that was in the beginning remained the same till the end. Now let's solve part A, which says to calculate the correct value of inventory at 30th September 2020. So we are already given with a value of closing inventory, which was in the list of balances, amounting to 26,300, right? Yes, 26,300. Now we were told that inventory which has a cost is equals to 5,200, whereas the net realizable value, the NRV, is, what is the formula to calculate NRV? Estimated selling price minus the repair cost minus the cost to sell. So in this question we have repairs, and this has repairs costing 600. The items could be sold for 5,000. So the estimated selling price is 5,000 minus 600 repairs cost. This means that the NRV would be 4,400. So we have to compare the cost with the NRV, and whichever of the two is lower, we'll be taking that value. Which one is lower? The NRV is lower, of course. So we'll be considering NRV. This means that in this 26,300, we have added 5,200 incorrectly, which is overstating my closing inventory at the moment. So I have to subtract closing inventory amounting to 5,200 and add back 4,400, which is the correct value, the value which should have been included as inventory in my closing inventory. So this will give me a figure of $25,500 of corrected closing inventory. Right? Now moving towards part B, it says calculate the revised profit for the year ended 30th September 2020 after adjusting for errors 1 till 3. Right? So we'll be starting with the draft profit, which was 84,900. Yes, it is 84,900. Now errors 1 till 3. In first error, we have already seen that inventory was being overstated. Why? Because it was valued at cost. However, it should have been valued at NRV. So can we find out by how much were we overstating the closing inventory? Yes, we can, by taking the difference between the cost and the NRV. So that will be 5,200 minus 4,400, 800. Previously my inventory was overstated by 800. Now establish the relationship between closing inventory, if that is overstated, with profit. If my closing inventory is overstated, my cost of sales would be understated, because I'll be subtracting a bigger value, a larger sum from my cost of sales. So that will understate my cost of sales, and which will overstate the profit. So by overstating closing inventory, my profit was also being overstated. Now in order to correct the profit, I will have to reduce it by 800. So 800 will be subtracted from the draft profit. Why? Because previously my closing inventory was being overstated. This will eliminate the effect of overstatement of inventory. So this was error number 1. Right? Now error number 2 is that operating expenses included insurance 400, which was prepaid. So why are we including a prepaid expense which doesn't belong to current year? It shouldn't become part of my current year's expenses. So again, now what is happening? An expense is being overstated. This is being overstated right now. I have to reduce my expenses, which will increase my profit. Always think of the impact, not directly on the profit, but how is it impacting the expense, and how will that expense impact the profit. So second adjustment is related to insurance, which will be added back to the profit. Add insurance expense prepaid. Prepayments are not that doesn't become part of the expenses, rather they are subtracted from the expenses. So 400 will be added back to the profit, as it will reduce the expense and increase the profit. Now last error is that we haven't taken into account provision for doubtful debts, which should be 5% of trade receivables. So my trade receivables currently are 14,500. Apply 5% to it, that will be 725. Now this is the closing figure, this is the carried down, this goes in the SOFP, not in the income statement. What goes in the income statement is the difference between opening and closing figure, and the difference is of $100. Opening is 625, closing is 725. So this is increasing. An increase of 100 in the provision for doubtful debts is an expense. It should become part of current year's expenses. This means that my expense will increase, that will reduce my profit by $100, so 100 will be subtracted. So less increase in provision for doubtful debts, or you can say less provision for doubtful debts omitted, right? This will give me a corrected profit of 84,900 minus 800 plus 400 minus 100, $84,400, right? So this is the revised profit. Now moving towards the third part, prepare the statement of changes in equity for the year ended 30th September 2020. Now the format is given to us. We have 4 columns: share capital, general reserve, retained earnings, and total. We have to start with the opening balances on 1st October 2019, and we have to end at the closing balances, of course, on 30th September 2020. Okay, so let's begin with the opening balances. For share capital, we were given the amount of 200,000, I guess. Issued share capital 200,000, yes, and let's write that down. For general reserves, we have 6,500, and lastly retained earnings amounting to 73475. The total of this would be 279975. Now you might be thinking that no date was mentioned with retained earnings. So some of us can assume that this is the closing balance. We can write, should we write 73475 under as for 30th September 2020, and we work backwards to adjust for the dividends paid and profit for the year and transfers to general reserve, so that we arrive at opening balance. Now why we can't assume retained earnings amounting to 73475 as opening balance? Because I can understand that since no date was mentioned with this, no closing or no opening date, so we can assume that it might be the balance at 30th September 2020, but we can't do that because right after this information we were given with the profit for the year, and that required adjustments. Moreover, we were also given with the dividends paid during the year that are also adjusted from the retained earnings balance. So we have to assume that this is the opening balance for retained earnings, and in that we will be adding the revised profit, we will be subtracting the dividends paid during the year, because if such information is given after retained earnings, so we have to assume that this is the opening balance, not the closing balance, right? So let's begin with the adjustments. In this question we have 3 types of adjustments that will be done in statement of changes in equity. There are dividends paid amounting to 2,000 will be subtracted from retained earnings. Then we have profit for the year, revised profit, which we have calculated in part B, that will be added in the retained earnings 84,400. And lastly we were also given with the transfers to general reserves 5,000, which will be added in general reserves and will be subtracted from retained earnings. So let's write all of this down. So profit for the year is 84,400, the revised profit, of course, that will be added in retained earnings and also in the total column. Then the dividends paid were 2,000, subtract from retained earnings and from the total column as well. And lastly transfers to general reserves, added in general reserves and subtracted from retained earnings, no impact on total value. So that's it. There were no shares in issue during the year, there was no revaluation, so these are the only adjustments required. Let's calculate the final balances. Issued share capital would remain the same, 200,000. General reserves would increase to 11,500. Retained earnings would be 158.75, and my total would be 362,375. Right? This is how we prepare our statement of changes in equity. Now, the last part is related to the preparation of statement of financial position. So, we are given with 3 columns, SOFP, which means that first column would be related to the cost of non-current assets, second would be related to the accumulated depreciation, there is in question, right? And the last column would be of course related to the net book value. Be careful when filling this type of sheet, because we are given with just one sheet, one paper, just one paper to complete the SOFP, right? So you have to do everything in this sheet only. Let's begin with the first heading, which is related to non-current assets. We are not given with individual assets, rather for accumulated non-current assets, right? So we have cost amounting to 462,000 and provision for depreciation 106,000, right? So we just have to write that down. 462,000 is the cost and accumulated depreciation is 106,000. The reason why I am underlining this is because so that we don't confuse it by adding it in the further calculations which we'll be doing in the later part of the SOFP, as these two figures won't be used anywhere. We'll be using the net book value, which is 462,000 minus 106,000, 356,000 in the later calculations, while we will be calculating total assets. Then the second part of the second heading is related to current assets. In this we include closing inventory, right? We calculated that in first part A, and we also include trade receivables that were also given to us. And don't forget that we show the subtraction of provision for doubtful debts, less provision for doubtful debts, which we calculated for finding out the revised profit. Lastly, we are also given with other receivables. We don't have bank or cash because, as we saw in the list of balances, we have bank overdraft, so that is a liability. Now let's fill these. Closing inventory is not 26,300 but the corrected value 25,500, and we'll be writing that in the second column. Why? Because first column we'll be utilizing for finding out the net trade receivables, right? The trade receivables given to us in the list of balances were 14,500, and we'll be subtracting 725 provision for doubtful debts from this value, which will be shown in SOFP. So 14,500 less 725, which will give me net trade receivables of that I will show in my second column, 13,775. Other receivables are how much given to us in the list of balances, amounting to 1600 are the other receivables. But are these the only other receivables? No. 1600 plus 400. Where is this 400 coming from? We were told in the adjustments that insurance prepaid amounting to 400 was included as an expense. So we know that a prepaid expense is an asset for the business, as its services will be received, will be utilized, will be incurred in next year. So that is treated as a current asset in the current year, any prepaid expense, right? So 400 will be added to the other receivables because previously it wasn't treated this way. So 1600 plus 400, 2000 are my total other receivables. This means that my total current assets would be 41275, which will give me a total assets figure of 397275. This is what? This is my total assets. Now this should match with the second part of SOFP as well, which is equity and liability. So let's write that down. Equity, starting with ordinary share capital, we'll write ordinary share capital, retained earnings and general reserves, and we'll be taking the closing balances for these, which we have calculated in part C. So 200,000 plus 11,500 plus 150,875, and we can write that all down in the second column. Total is 362,375. Then the non-current liabilities, if there is any question, in this question we have 8% debentures, so that we will write non-current liabilities 8% debentures amounting to 18,000. That we can write in the last column because that is the only non-current liabilities in the question. And last part is related to current liabilities, of course. Current liabilities. The first one was bank overdraft, right? And there will be trade payables, and other payables would also be there. Other payables. So bank overdraft is 6450, and trade payables are 8250, and other payables are in the question 2200. So these are the three current liabilities which we have: bank overdraft 6450, trade payables 8250, and 2200. Total is 16,900. Now we just have to add our equity and liabilities. That will be that will give me a total of 397,275. So that is the total equity and liabilities, which is matching with my total assets as well. So this means that my SOFP is balancing equity and liabilities. If we make all the adjustments correctly, if we don't forget to add the revised values, if we don't forget to add the errors that were made in the question, add or subtract, adjust for the errors made in the question, and adjust for the corrected values in the SOFP, so the chances are that our SOFP is much likely to balance. So I hope that this question was clear, and I'll see you in the next video with the last question of this series. Take care. Allah Hafiz.